All right, well, the S&P came out of options expiration on a good foot, going up an eighth straight day, 9 out of the past 10 trading sessions. A very strong move over this past couple of weeks, coming off of that August 5th low point with that high volatility index. So we're going to break down how that move looks in context to other moves that have started new bullish intermediate trends. And take a look at some of the patterns that we're seeing already, some of the patterns that we haven't started to see yet that may suggest just how early on in this stage, in this cycle that we are, despite the strong move that we've already had. So we'll break all that down in today's class, taking a look at the sectors. Very good sector rotation today, very good breadth, even with that sector rotation. So we'll look at that as well. But that's the kind of moves we like to see, and suggesting again there might be some more to come. And we'll take a look at our trade idea as we always do, which has been we've had a very common trade idea over the past couple of weeks as we've been rallying, and today's will be no different. Same in the technology sector, a stock that appears that is showing us a lot of the patterns that we would like to see on the S&P 500 that we're starting to see on this stock. So we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, August 19th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. And if you're following us on our blog, check out some of these other things over here on the right, including our Market Outlook live video where I take a look at old Market Outlook trades, see whether we should stay in them, get out of them. We also put on today's trade already before the market closed. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab, hit that like button. The more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those that do this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see 8 days in a row we've been to the upside now, and 9 out of 10. So in 2 weeks we've gone up 9 out of 10 9 of those 10 trading sessions, coming off of the Monday, really the Black Monday of 2024. If you were to compare it to 1987 and the big down day we had on the Monday back then. You could almost compare it because of how high the VIX went. The VIX went higher here than it's been in a long, long time. Since COVID, that we've had it really that high, even if it was just on an intraday basis. But if you take a look at the rally since, has been great. I mean, if you look at the rate of change here for the past 10 days, it is on par with other, very significant moves to the upside. You can see up over 8%, and that includes a pretty significant down day there, but you can kind of see like it's been since the correction of 2022 that we've had moves this high over this time. Also coming off of the intermediate low of 2020, the election as well as the vaccine rollout there. Of course, COVID. You can see coming off the 2018 low point, we were pretty high in a short amount of time. If I were to zoom out even further, you can see also 2011's in there, the move off the lows in 2011. We had some pretty significant moves, and of course coming off these bear market lows, as well as the one intermediate pullback we had in 2009, and then nothing before that, right? So very significant move here. Like, again, it's either coming off correction lows or starting some really, really good moves because of a significant change in, in this case, the macro picture, the macro environment. Essentially, the beginning of the reopening trade is what happened there. So very, very good move. Of course, the VIX was high, so it's not surprising, but it's brought that near-term line up into bullish territory. It is now above market sentiment. That's a very good sign. The near-term line remains at extreme highs. That's a very good sign as well. Very, very good sign that we'll continue to stay bullish on the intermediate line. The momentum line's kind of hovering. That's okay. As long as it doesn't drop to extreme lows, it's okay what it's doing there. And we're almost above that key 2.5% mark, which really kind of starts the trend, right? When you kind of break that rubber band, that window that we have around the moving average, that envelope around the moving average. So getting up by a good amount will lower the odds that will fall back down. Especially again, consider that you can have a 2.5% move and just be a normal retracement and fall and be back below the moving averages. So we kind of want to avoid that by getting further up above that moving average so we can maintain the bullishness. Let's take a look at some of the other indexes. Of course, your NASDAQ 100 has got that bear tag. It's built on it now today, coming out of options expiration. It's also not quite above the 2.5% mark. The intermediate line is not quite in bullish territory yet, or above its moving average or market sentiment line. But at least the near-term line is up at strong levels. Looking at the Dow Jones Industrial Average, same thing. It's crossing the market sentiment. It's crossing into bullish levels. It's strong near-term line, dark green shading, and a green line. And then finally, the Russell 2000, which has been the weakest, has a green line now. With today's move, you are above the moving average. It's rising, and you have light green shading because we are out of bearish territory now. We're not quite above the chart's midpoint yet. We're not quite above market sentiment or into bullish territory. So we're lagging, but at least the near-term line has really made a run these past few days to get up to extreme highs itself. So again, increasing the odds that the intermediate line will continue higher too. Let's take a look at the weekly chart for the S&P 500. You can see we've got a very strong weekly candle. Remember how strong that bearish candle was? Well, we've reversed it with a pretty darn strong bullish candle. You can see you typically don't go in 2 weeks from extreme low to extreme high. Eventually you might get up there, but not in just 2 weeks. We've gone in 1-2 weeks. We've gone from one of your bigger down candles we've had for a couple of years to now one of our biggest bullish candles that we've had in a couple of years. So significant change. You can see as of right now, the Hakinyashi close is above last week's high. That's a very, very good sign for reversal. Obviously, we have a higher high already this week. We have the green line. The moving averages are both rising. The PPO is rising again. It's at high levels, and it's in the 86th percentile, but at least it's rising again. So that's a good sign as well. We have 3 green arrows across the board and green lines. Right now we have 3 green lines and 3 green arrows all across the board. So that's a good sign as well. It's very strong MACD histogram, so very good momentum across all of these. Of course, the Russell's lagging, but it's catching up. All right, it's catching up there. Looking at the 2-line version of those 3 green arrows, you can see your 8 days above the 17, that's why the MACD is positive, and they're both really close to crossing back above the 30, which is also very positive for a new trend to develop. The stochastics is in bullish territory. You can see this momentum that we had is, again, one of your stronger momentums that we've seen for a while. If you were to look all the way back, we have to go back to these momentum moves coming off of these correction lows to get the histogram to be as high as it is right now. So it's one of our stronger moves that we had, even stronger than the last 2 intermediate runs that we started. So that's a good sign for the S&P 500. This is where things start to look a lot better than we saw last week. Your DMI is not quite above 30, but at least it's above 25, and it's pretty clear now. And your negative indicator is not back below 20 yet, but at least it's below 25, and that's pretty clear. So, you get these moves where they can be potential failures and just reverse, and that looks like we're going to avoid that being the case, where we're just going to fail here and reverse back down to the downside. Your RSI and your CCI are also looking at least your RSI is looking very good. So now we can draw a green box here. So we'll go from to right now. So there we go. So now we can draw the green box here. Of course, this continues, right? So that's okay. We can just push this along further, and because we haven't crossed, if you look on the weekly chart down there, we haven't crossed below minus 100. We came really close, but now we're back up above positive 100. So very good move in that direction. So it'd be nice if we were above 150, because that's kind of like the key to starting a new run, is getting up to above 150. As you can see back here, when we were coming off of this pullback low point, we didn't quite get there, and we still were able to get going, and eventually this breakout here is what really got us going to the upside, and that was a move above 150. But at least your RSI was above 60, and that's kind of what we're getting right now, as well as all these other indicators. Of course, we're above the cloud. Your rate of change is if it's not positive, it's right there at being positive. We don't even have a bullish trend starting yet. Your green lines cross above the blue line, so you have a green cloud now projected out 26 days. So that's a very, very good sign for the S&P 500 here. Looking at the Bollinger Bands and the Keltner channels, again, we are still in the upper band. We're not quite up to the very top, but at least we're pretty strongly in there at the 85th percentile. Good momentum. Bands are outside the Keltners. We're pushing up against the Keltners, really close to closing up above that. So we have a good pattern, a good trending pattern developing on the S&P 500 with this really strong move that we've had. If you take a look at the 4-week range, let's take a look at the 4-week range. We finally got a new 4-week high today. That's another factor. You can see we just continue to push high up to the highs of the day. So we got to 100 because of the new high tag, so that's good. The new low tag obviously is going to start pushing out towards 0. So it's a good sign that we're up above 100, especially when we have a strong range like this. It allows for some volatility to kind of fill up to this level, and that's the case. So very, very good move there. Of course, our range wasn't very big, but now that we're above moving averages, it's not going to be, right? So we had a 5.75 range, the volume at 39 million. So when you put those numbers into context, those are lower than average, but that's okay because the markets are bullish when these start falling, right? So and we've broken the 1.5% mark on the ATR. So we breaking below 1 is really when you start the trend, and that's a really good sign for us that we're that we're at least moving in that direction. We're still far ways away, but at least we're moving in that direction. Very, very good sign for the markets. And then finally, another good sign for the markets today, the VIX dropped below 15. For a period of time, the VVIX was above 100. We haven't had that combination of the VVIX above 100 and the VIX below 15 since February 1st of 2018. And we all know what happened February 2nd and beyond. We're still, the volatility is still pretty high. The VVIX is still really, really high. We jumped up pretty significantly on the VIX. Of course, the VVIX jumped up too. But the VIX has really dropped down sharply and getting below 15 and getting below 85%. I mean, we're pretty oversold on volatility. Interestingly enough, though, we are not below the 200-day average of the volatility. That's how low volatility has been for such a long period of time. We're still actually above the 200-day moving average. Again, getting back below the 200-day moving average is when you really get a good trend starting. So we're not quite there yet. You can see how we've made some good progress in 2 weeks, and we haven't really even started the trend according to a lot of these indicators yet, which, on one hand could be like maybe we've gone up a little too much here, but on the other hand, it also suggests that we may be very early still, even though we're up 8% and we have a good zigzag here. Up 8.14% already, and we're not quite up to new highs, but we're really close. So even though we got that tag, that we might be in the very early stages because of these indicators that are still kind of on the cusp of showing that we are starting a new bullish trend. Now let's talk about what's driving the price action today. You can see both the Qs and IWM both rallied, so that's a really good sign for U.S. equities when both those kind of higher beta indexes ended up with their best performances. Even even developed markets did very well. Emerging markets outpacing the S&P 2. Bonds ended up pushing higher. Again, that had been trending towards a negative correlation, but it's returning back to a positive correlation. As you can see, we're back to a 77% positive correlation over 10 days, over 2 weeks. So it's really those falling yields have been a huge benefit for equity, for risk appetite, to see those yields coming down. If you take a look at the yield, the 10-year yield here, it kind of made a strong break today. Here we go. It's staying below 4%, working its way back below the 8-day moving average. In convergence mode because the MACD is above its moving average, coming off a significant low, but still not breaking the 17-day yet and really starting to trend higher. We'd have to get back above 4%. And of course, it doesn't look like we're probably going to be back above 4% anytime soon, as the odds for interest rate, first of all, as economic surprise still is very negative, and that has a dampening effect on yields. but also the odds of rate cuts continue to be pretty high. As you can see, obviously we have 100% odds. We have 100% odds for cuts in our next 5 meetings. So this isn't just a kind of a one and done, a mid-cycle adjustment like the last one we had in 2019 or even 2005, because a lot of people talk about 1995, excuse me, being similar to what we saw now, because it was a soft landing, right? Well, even that was a semi mid-cycle adjustment as well, because you can see we actually started the year with a rate hike, one last 50 basis point hike in early 1995. Then we cut by 25 in July, and then we waited all the way to December to cut again, and then we cut in January, but then we didn't cut again in 96. So again, a soft landing, kind of like 2019. Let's see, it would be Powell. In 2019, we had 1, 2, 3 cuts kind of back to back to back, and that was really it. In fact, they called that their mid-cycle adjustment. And so 1995 was very similar. We had, we had the one right there, because that was a rate hike. So 1, 2, which was not the next meeting, it was months later, and then the third, which was that next meeting, and then that was it. We didn't get another cut. The next move was actually a hike in 1997, and we didn't get a cut again until we had that debacle in 1998, where we dropped because of long-term capital management crisis. So that's a little different than what we're expecting now. We're expecting 100% odds here in September, 100% eventually, 100% odds in November. There's your November right there, 100% odds. 100% odds in December. There's 1, 2, 3. 100% odds in January. 1, 2. This is, we don't have the 1 because 5 1/4, 5 1/2 is off now. So 1 below, 2, 3, 4, and then close to 100% odds in March. There we go. So again, we don't have 5 1/4, 5 1/2. So 1's down below, 2, 3, 4, 5. So 100% odds for cuts at the next 5 meetings, and then by September. We're pretty much at about a 95% chance, 94% chance of being at 3.75 to 4% on the Fed funds rate. That's where the 10-year yield is right now, right? Because the 10-year yield is right in that range at 3.86. Right in the middle, it's 3.75 and 4%. So the Fed has to cut just to get the yield curve to being flat, much less back to its normal curve, right? The normal curve that it has, because right now it's an abnormal inverted curve. But to get it back to a normal curve, the Fed has to cut all this, and the 10-year yield has to not only not go down, which is very rare to do, because if you notice, when yields fall, when the short end starts to fall, everything falls, right? All the longer term yields fall as well. There we go. So you can see when the short term rates fall, which is these red and yellow lines, when they start to fall, everything falls with it, right? Here's the red and yellow lines there. They start to fall because the Fed's cutting rates or anticipated to cut rates. Everything falls with it until the Fed's done cutting rates, and then yields start to rise at that point. And you can see that and down here as well. They've done cutting rates, and then the long term starts to rise, and that's what makes the yield spread down here rise. Once they're done cutting. That's what makes it that last leg higher. You see, it starts to rise when they cut, and then that last leg higher when the long-term rates rise. That's when you get to the highest spread. And once you get to that point and coming down, that's really bullish for the market. Even being inverted is really bullish for the markets. But the problem is when we rise above zero and start to take off, that's not very bullish for the markets. So this is different because again, we never. Like the Fed made this move, like they were already down here to its lowest point by the time we were at these low levels. We didn't get down to the lowest point until the yield spread is already at a normal 150 basis points. So a little different scenario. This is more like that last leg lower. This move right here coming out of the mid-cycle adjustment we had in 2019. And remember, if I were to go all the way back to 1995, so we'll go back to 1990 here. So here's 1994, 95. The yield curve never did invert in 94. As you can see, the yellow and red lines never did get on top of the longer term rates by the time the Fed was done raising rates. So that's a much different scenario than what we see right now, where the yellow line is well above those long-term rates. So that's a much different scenario there. And you can see by the time they were done cutting rates, which was in January of 96, that was their last rate cut. Long-term rates rose again, but that was it, right? That was just that last leg higher, similar to 2019. So by the time they were cutting rates, by the time they finished cutting rates, you can see we were still well under 100 basis points. So we didn't have very much to go up anymore by the time long-term rates rose. So kind of it's a different scenario than where we're at right now. When short-term rates start falling, because the Fed's going to cut rates at the next 5 meetings, the 10-year yield will fall too. So that really puts a lot of pressure on the Fed, because their cutting will not uninvert the curve. It will still keep it inverted. So they're going to have to do a lot more. They're going to have to make the 10-year yield go up while they are cutting rates in order to get the yield curve back to its normal, to up above the 50, 100 basis points, and really set us up for a good long bull market where that spread, because see what we want for a long-term scenario, we want the spread to be up here at 200, 250 basis points, because this sparks new long-term bullish trends in equities. Same thing here, right? It sparks these very good long-term trends in equities when we're coming down from these high levels down towards zero and even to inverted curves. We want that, but you can't do that when you are barely getting up here, even coming off of this level in 2021. We had some room to go to the downside by the time we got to 2022, but again, the Fed started raising rates and we were in correction mode at that point. We needed up here. And for it to get up here, something's got to give. And which means, because of how low the 10-year yield already is, because how much they have to cut rate, they either have to cut rates back to zero or close to it, maybe 1%, to get back up to 200, 250 basis points, which is very unlikely. So they either have to do that, or while they're cutting, the 10-year yield has to rise, which, as you can see here, is not the norm. But again, that's pretty much the only way that the bond market would normalize itself. And in any of these situations where the bond market normalizes, you can see they're shading. They're shading there, they're shading there, they're shading there, they're shading here. They're shading when you start to normalize from even just a small inversion. And this obviously has been the biggest version. And it's not just that too. When you look at the 2-year compared to the 3-month. So these are both very short-term rates. The 2-year is the path of rates. The 3-month is the proxy for the current effective Fed funds rate. So there's a pretty good gap between those two. In fact, on record, it's the biggest gap, and it has been inverted for a very, very long time. So, again, that has to fix itself with something happening, because it's going to take, again, all these cuts just to get down to 4%. Right? Remember, 3.75 to 4% by next September is what the Fed funds futures market saying. Well, that's what it's going to take just to get down to where the 2-year is now, just to get this curve back to zero. So back to zero here, much less get it back to kind of normal levels up here at around that 50 basis points to 100 basis points there. So we've still got, the market still has a lot of work to do to fix itself from these excesses that we're seeing, and for that matter, the extreme moves to the downside that we've seen in bonds, right? And you can see bonds have really been making away. They're above moving averages now. We're above the 200-day. We're still nowhere near the 200-week, and we're the furthest below the 200-week that we've ever been on TLT. So we still have a long ways to go just to get back to the 200-week moving average, much less start a new bullish move up above it, right? Which is what you would expect that we'll see when there's demand for this much demand for bonds. It's unlikely stocks will continue to have the same demand unless we remain in an inflationary environment where stocks and bonds happen to move together. If you take a look at how the sectors performed today, this was very, very normal move. In fact, that's another reason why this is such a good thing. You notice the best performers today were XLK, XLY, and XLC. That's what you want to lead the markets. All three of them outpaced. The rest of them didn't, but that's okay. This is what you want to lead the market. Again, we have a lot of work left to do because from the NASDAQ 100's high point on July 10th, so starting July 11th going forward, you'll notice that they're still very much the underperformers, right? The S&P is almost back to break even. They're almost back to break even, but they're not back to break even relative to their peers, which are still outpacing. But they're making a run, right? And that's the beauty that if you look at the sector rotation here, they are making a run. All of these sectors that are all negatively correlated with the S&P are all moving down to the left. And the one main sector that's driving the market, because your three biggest companies are in it, is moving up to the right. And it's coming off of extreme lows on the relative. That's the lowest low that's ever had. This is the highest momentum move we've had in years on this particular ETF on the RRG chart. So it's a great run that we cannot let putter out, right? You can see discretionary still hasn't gotten back above the 200-day moving average relative to staples. If you look at the Qs relative to IWM, we are above the 200-day, but we're not, we haven't cleared it really significantly. We haven't cleared the 50. We're not back to trending higher. Remember, we're still, the levels we're currently at right now, it's not like we have a long ways to go to the upside, because the levels we're at right now are still extremely high levels relative to where we've been in the past. This is where the Qs were relative to IWM in the tech bubble. And then the other thing too that's limiting good long-term new moves to develop from here is the fact that your CAPE ratio is already above 36. So again, doesn't mean we can't get a new intermediate run, but it most likely means that we are still in the late cycle stages of this market sentiment rally that we've been on since coming off of this Halloween low point. This market sentiment run's been up. It's still in bullish territory, and most likely will stay in bullish territory on this because of this intermediate run that we're about to potentially embark on right now. All right, that brings us to our trade idea of the day. Let's take a look at DocuSign. DocuSign kind of looks like the market, kind of looks like a lot of the trades we've been doing lately. Dark green shading a green line. Market sentiment is a little lower for DocuSign, and it did drop in the bearish territory. So there is an opportunity for a breakout here for a new intermediate run up to the upside. It's a good, strong near-term rally. It's still up above the intermediate line, even though it's declining. If you look at the weekly chart here, you can see that we have a good bullish candle. You had a green arrow. We're back above both the 10 and 40-week exponential moving averages. We have a higher high. We obviously have a higher Hakinashi close. We have 3 green arrows, obviously, on the stock. And when you break those lines down, I can see what I'm typing here. The 8 and 17 day are moving above the 30. We're above the point of control. MACD and stochastics are in bullish levels. Very good sign there. Looking at some of these other oscillators, you can see the DMI looks positive. Right, you have your positive breakout there. You need to get that negative line a little bit lower, but your positive line's at a very strong level. Your RSI and the CCI kind of look like the S&P 500 as well. The CCI is not quite exactly where we want it, but your RSI is above 60, so that's a good sign too. Your stock is above the Ichimoku cloud. The cloud has turned green, just like the S&P did here going into earnings before the next expiration. And you can see we don't even have a bullish trend started yet. You have positive rate of change over there. Looking at the Bollinger Bands and the Keltner channels, you can see our momentum has just flipped to being positive. We are in the upper quartile, pushing up against the upper band and the upper Keltner channel. They're both rising, so very good sign. So what we decided to do here, is to sell the $62 strike and buy the 60. So at the time it was closer to your mid-30s delta. The stock dropped here into the close, still up about 0.75%. You can see the move that we have to make. The high point up there is up at 60. Would be 62. And you can see plenty of room for flexibility for the stock it doesn't have to go up immediately. Doesn't have to. We don't have to time this exactly right. We like that because it gives us the ability to for the stock to kind of do its thing before. But again, considering it's in a good trend, we have a good opportunity here. Almost about a 2-to-1 reward to risk ratio, just a little shy of $500 at risk, like we normally put on directional trades, and up to almost $1,000 in gain. So a good opportunity to try to take advantage of the same kind of move we've been doing a lot, and try to take advantage of the S&P potentially starting a new bullish trend. Despite going up over 8% in 10 days, the potential that it might be starting a new bullish trend is there because of all these signs, and a lot of these trades we've been doing over the past couple of weeks are going to be able to take advantage of that. All right, well, that wraps us up for today. You've heard from me now. Now I'm going to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.